The stock market creates a strange illusion. Every day, prices move up and down, financial news becomes more dramatic, and millions of investors try to decide whether they should buy, sell, or wait. Because the numbers change constantly, investing can appear to be a game of prediction. People search for the next winning stock, the perfect moment to enter the market, or the expert who can explain what prices will do next. Benjamin Graham believed this was the wrong way to think. In The Intelligent Investor, he argues that successful investing does not require extraordinary intelligence, secret information, or the ability to predict every market movement. It requires something more difficult. It requires discipline. Graham wrote from personal experience. He built a successful career on Wall Street, but he also lived through the devastating stock market crash of 1929 and the Great Depression that followed. Those events showed him how quickly confidence can disappear, how easily borrowed money can become dangerous, and how little control investors have over short-term prices. But they also taught him that falling prices do not always mean falling value. A strong company can become cheaper because investors are frightened. A fashionable company can become dangerously expensive because investors are excited. The market price and the real value of a business are not always the same. This difference lies at the heart of Graham's philosophy. An intelligent investor does not treat a stock as a number moving across a screen. A stock represents partial ownership of a real business. The investor's job is to estimate what that business is worth, purchase it at a sensible price, and protect against the possibility that the estimate is wrong. That sounds simple, but following it requires resisting greed when everyone is optimistic, resisting fear when everyone is pessimistic, and refusing to confuse excitement with intelligence. Blink 1. Investing and speculation are not the same activity. Graham begins by drawing a clear line between investing and speculation. An investment operation is based on careful analysis, aims to protect the original capital, and seeks an adequate return. Anything that does not meet those conditions is speculation. This does not mean speculation is always immoral or foolish. A person may consciously take a risk in the hope of earning a large reward. The danger begins when someone is speculating but believes he is investing. A person buys a rapidly rising stock because everyone is talking about it. He performs little research, has no estimate of the company's value, and expects to sell it to someone else at a higher price. That is speculation, even if the company is famous and the purchase eventually makes money. An investor approaches the same situation differently. She studies the company's earnings, financial strength, competitive position, and long-term prospects. She asks whether the price provides a reasonable return compared with the risks involved. The difference is not the stock itself. It is the reasoning behind the purchase. Graham warns that speculation becomes especially dangerous when people use money they cannot afford to lose, borrow heavily, or allow short-term trading to dominate their financial lives. Markets can reward poor decisions for a while. A rising price can make a careless buyer feel intelligent, but a profitable outcome does not automatically prove that the decision was wise. Someone can make money in a casino. That does not transform gambling into a safe investment strategy. This distinction matters because the market encourages speculation. Prices change every second. News creates urgency. Stories about fast profits make patience feel outdated. Yet the investor who constantly reacts to these movements gives the market control over his behavior. The first step toward intelligent investing is therefore knowing which game you are playing. If you are investing, your decision must rest on analysis, protection of capital, and a reasonable expected return. Once that distinction is clear, the daily movement of prices begins to look less like an instruction and more like an opportunity. Blink 2. The market exists to serve you, not to guide you. Graham explains market behavior through one of the most memorable characters in investing, Mr. Market. Imagine that you own a private business with a partner named Mr. Market. Every day he appears and offers either to buy your share of the business or sell you his share. The business itself may not have changed, but Mr. Market's mood changes constantly. Some days he is extremely optimistic. He believes the future will be wonderful and offers a very high price. On other days, he becomes frightened. He expects disaster and offers a very low price. You are free to accept his offer or ignore him. Mr. Market does not become more intelligent simply because he appears every day with a new price. His offer is useful only when it benefits you. The real stock market works in a similar way. Investors often treat market prices as if they contain instructions. When prices rise, they feel safe and want to buy. When prices fall, they become afraid and want to sell. Graham argues that the intelligent investor should reverse this relationship. A rising price may be a reason for caution because the investment is becoming more expensive. A falling price may create opportunity if the underlying business remains sound. The important question is not whether the stock has recently risen or fallen. It is whether the current price is attractive compared with the company's value. This requires emotional independence. When the entire market is optimistic, refusing to join can feel uncomfortable. When prices collapse, buying can feel reckless, even if the valuation has become attractive. Mr. Market's greatest power comes from persuading people that his mood should become their mood. Graham wants investors to use market fluctuations without being controlled by them. If the market offers an excellent price, take advantage of it. If the market offers an unreasonable price, do nothing. You are not required to trade simply because the market is open. Sometimes the most intelligent decision is to wait. Blink 3. A stock is ownership in a business, not a lottery ticket. Investors make better decisions when they remember what a stock represents. A share is not merely a symbol, a chart, or a price that changes throughout the day. It is a small ownership interest in a real company. That company has assets, employees, customers, debts, products, and profits. Its long-term value depends on the cash it can generate for its owners. When people forget this, investing becomes a popularity contest. They purchase whatever is receiving attention and assume that a great company must automatically be a great investment. But Graham separates the quality of a business from the attractiveness of its stock price. A strong company can be a poor investment if the price already assumes years of perfect growth. A less exciting company can become an excellent investment if the market price is far below the value of its assets and earning power. Price matters. Suppose a business is worth approximately $1 million. Buying the entire company for $500,000 may provide a large potential return and significant protection against error. Buying the same company for $2 million creates a very different investment, even though the business itself has not changed. The intelligent investor must therefore think like a business owner. Before buying a stock, ask whether you would be comfortable owning the entire company at the same valuation. Would its profits justify the price? Is the balance sheet strong? Can the company survive difficult years? Are the earnings stable, or do they depend on unusually favorable conditions? This approach shifts attention away from short-term market excitement and toward long-term business performance. It also makes market declines easier to understand. If you owned a private shop, farm, or factory, you would not demand a new price for it every afternoon. You would focus on revenue, expenses, assets, and the strength of the business. Public stocks should not be treated completely differently simply because prices are visible every second. The market price matters when you buy or sell. The business matters during all the years in between. Blink 4. The margin of safety is the foundation of Graham's philosophy. No investor can know the future with certainty. Company forecasts may be wrong. Economic conditions may change. Management can make mistakes, competitors can become stronger, and industries can decline. Because uncertainty cannot be removed, Graham does not ask investors to make perfect predictions. He asks them to leave room for error. This is the margin of safety. The idea comes from engineering. A bridge designed to support 10,000 kilograms should not collapse at 10,001 kilograms. Engineers build additional strength into the structure because estimates may be wrong and conditions may become more difficult than expected. Investments need the same protection. If a company appears to be worth $100 per share, buying it at 95 provides very little room for error. Buying it at 60 creates a much larger cushion. The lower price cannot guarantee success, but it reduces the damage if the valuation was too optimistic or an unexpected problem appears. The margin of safety can come from several sources. A company may have valuable assets, low debt, stable earnings, or a market price significantly below a conservative estimate of its value. Diversification also creates a margin of safety because one mistake does not destroy the entire portfolio. Graham's emphasis on safety does not mean avoiding all risk. Every investment contains uncertainty. The goal is to take risks in situations where the potential reward is attractive and the downside has been carefully considered. This principle becomes especially important during periods of excitement. When investors believe a company cannot fail, they become willing to pay almost any price. The margin of safety disappears because the investment depends on everything going according to plan. But even excellent businesses experience setbacks. A high price turns an ordinary disappointment into a major loss. A sensible price allows the investor to survive imperfect outcomes. Graham believed that the margin of safety was the central concept connecting all intelligent investment decisions. You cannot control the future, but you can control how much protection you demand before placing your money at risk. Blink 5. The defensive investor should choose simplicity and consistency. Graham divides investors into two broad groups: defensive investors and enterprising investors. The defensive investor is not necessarily fearful or inexperienced. This person simply wants a reliable strategy that requires limited time, effort, and specialized knowledge. A defensive investor may have a demanding career, family responsibilities, or little interest in analyzing individual companies. For this person, complexity can become a source of mistakes. Graham recommends broad diversification, financial strength, and a balanced approach between stocks and high-quality bonds. The exact allocation can change depending on market conditions and personal circumstances, but the principle remains stable. Do not place everything into one type of asset. Stocks provide long-term growth and protection against the loss of purchasing power. Bonds provide greater stability and income. Holding both can reduce the temptation to make emotional decisions during extreme market movements. The defensive investor should also avoid constantly changing strategy. Frequent trading creates costs, taxes, and more opportunities for emotion to interfere. A simple plan followed consistently is usually more effective than a complicated plan repeatedly abandoned. Modern investors can apply this principle through diversified, low-cost funds rather than attempting to select every stock individually. This approach may seem unexciting, but Graham does not measure intelligence by activity. An investor is not more intelligent because he trades often, follows every market rumor, or owns complicated products. The defensive investor succeeds through discipline, diversification, and patience. The goal is not to outperform everyone during the most exciting year. It is to achieve a satisfactory return without exposing the portfolio to unnecessary danger. This requires accepting that some investors will temporarily earn more. During speculative booms, conservative investors may appear foolish. Their portfolios rise more slowly, and they may miss fashionable opportunities. But investing is not a competition to appear smartest in the short term. It is a long-term process of preserving and increasing purchasing power. For most people, a dependable strategy that can be maintained for decades is more valuable than an aggressive strategy that looks brilliant until the first serious decline. Blink 6. The enterprising investor must work harder, not merely take more risk. The enterprising investor is willing to devote significant time and effort to security analysis, but Graham makes an important distinction. Being enterprising does not mean being reckless. It does not mean buying more speculative stocks, trading constantly, or using more borrowed money. It means performing more work in search of opportunities that the market has mispriced. An enterprising investor may study unpopular companies, temporary business problems, neglected industries, or stocks trading below the value of their assets. The advantage comes from better analysis and greater discipline, not from accepting danger without compensation. Graham understood that attractive opportunities often appear in places where other investors are uncomfortable. A company may have experienced a weak year, an industry may have fallen out of favor, or a complicated situation may have discouraged casual investors. But low prices alone are not enough. A failing company can continue losing value. A stock can be cheap for a good reason. The enterprising investor must determine whether the problem is temporary or permanent. This requires examining debt, earnings, assets, management, and the competitive position of the company. Graham also warns investors not to confuse effort with results. Spending more hours studying the market does not guarantee superior performance. Many professionals possess more information than ordinary investors, but still make poor decisions because they follow the crowd, chase performance, or become overconfident. The enterprising investor needs a genuine advantage. That advantage might come from patience, a longer time horizon, specialized knowledge, or the willingness to study opportunities that others ignore. Without such an advantage, increased activity may simply create more mistakes. This is why investors should honestly decide which category fits them. A person with little time and no interest in company analysis should not behave like a professional stock picker. There is no shame in choosing the defensive approach. The dangerous position is pretending to be enterprising while making decisions based on tips, headlines, and excitement. Blink 7. The greatest enemy of the investor is often the investor. Graham believed that successful investing depends less on intelligence than on temperament. A person can understand valuation and still fail because emotions control behavior. Greed becomes strongest when prices have already risen. People see neighbors, colleagues, or strangers making money and become afraid of missing out. They purchase assets they barely understand because recent gains make risk feel invisible. Fear becomes strongest after prices have already fallen. Losses make investors imagine that declines will continue forever. They sell quality assets at low prices because emotional relief feels more important than long-term value. This creates a destructive pattern. People buy when optimism has made assets expensive and sell when pessimism has made them cheap. The market does not force them to behave this way. Their emotions do. Overconfidence creates another problem. A few successful investments can persuade someone that skill deserves all the credit. The investor begins taking larger positions, using debt or ignoring risks that once seemed important. Success becomes the beginning of failure because it removes humility. Graham's solution is not to eliminate emotion completely. That is impossible. The solution is to build rules that reduce the power of emotion. Diversification limits the effect of one mistaken idea. A predetermined asset allocation reduces impulsive trading. A written investment policy helps the investor remember what to do during a crisis. Regular investing can also reduce the pressure to choose the perfect moment. These systems are valuable because people make their worst decisions when fear or excitement is strongest. The intelligent investor prepares for those emotions before they arrive. Temperament also includes patience. Markets can remain irrational longer than expected. An undervalued stock may stay unpopular for years. An expensive market may continue rising even after prices appear unreasonable. Investors who need immediate confirmation may abandon sound decisions too early. Graham does not promise that discipline will always feel rewarding. He argues that discipline is necessary precisely because the correct behavior often feels uncomfortable. Blink 8. Past performance and popular forecasts can be dangerously persuasive. Investors naturally look at the past when trying to understand the future. They examine recent stock returns, company growth rates, and economic trends. But Graham warns that recent success often creates unrealistic expectations. A company that has grown quickly may attract investors who assume the same growth will continue indefinitely. The stock price rises because people are willing to pay more for each dollar of earnings. Eventually, even a successful company may disappoint because the expectations have become impossible to satisfy. This is one of the great paradoxes of investing. The better a company's recent performance appears, the more dangerous its stock can become if the price reflects excessive optimism. The opposite can also happen. A solid company may experience temporary difficulties and become unpopular. If the market price falls below a conservative estimate of value, poor recent performance may create opportunity. Graham therefore advises investors to be cautious when projecting past growth far into the future. Business conditions change, competitors respond, high profits attract new entrants, and successful products eventually mature. Forecasting becomes even more dangerous when precise numbers create false confidence. Analysts may estimate future earnings to the nearest decimal point, but the accuracy of the presentation does not remove uncertainty from the assumptions. The intelligent investor uses conservative estimates and accepts that the future will surprise everyone. Graham also warns against following popular market forecasts. When many investors agree about the future, their expectations may already be reflected in the price. A widely expected recovery may not create large profits because the market has already risen in anticipation. A widely feared recession may be less damaging to investors if prices have already fallen sharply. The relationship between events and investment returns is rarely simple. Being correct about the economy does not guarantee being correct about the market. The investor's advantage does not come from knowing exactly what happens next. It comes from paying a price that does not require an optimistic forecast to succeed. Blink 9. Intelligent investing is built on humility, patience, and independence. The lessons of the intelligent investor return to a simple idea. The investor cannot control the market. Prices will rise and fall. Popular opinion will change. Periods of excitement will be followed by disappointment, and forecasts will repeatedly fail. But investors can control how they respond. They can decide whether to treat stocks as pieces of businesses or symbols for speculation. They can demand a margin of safety instead of paying any price for an attractive story. They can diversify, avoid unnecessary debt, and select a strategy that matches the amount of time and effort they are willing to provide. They can also refuse to let Mr. Market determine their mood. When he becomes optimistic, they do not have to follow him. When he becomes frightened, they do not have to join him. His changing prices are offers, not commands. This independence is difficult because the market constantly rewards conformity in the short term. When speculative assets rise, disciplined investors may appear old-fashioned. When markets fall, patient investors may appear careless for refusing to panic. But Graham's philosophy is not designed to win every short-term comparison. It is designed to produce satisfactory long-term results while reducing the risk of permanent loss. The intelligent investor accepts that perfection is impossible. Every valuation contains uncertainty. Every company faces risk. Every portfolio will experience disappointing periods. The goal is not to avoid all mistakes. It is to make sure that no single mistake can destroy the entire plan. That is why the margin of safety matters. That is why diversification matters. And that is why temperament matters more than prediction. A person with exceptional intelligence but no emotional discipline may repeatedly buy high and sell low. A person with ordinary intelligence, a sensible plan, and the patience to follow it may achieve far better results. Graham's message remains powerful because markets change while human nature remains familiar. New industries appear, technology develops, trading becomes faster, and financial products become more complicated. But fear, greed, impatience, and overconfidence continue to influence investors in the same way. The intelligent investor does not need to defeat those emotions forever. He needs a system strong enough to prevent them from controlling his most important decisions. Key takeaways from the book. The intelligent investor teaches that investing is different from speculation. An investor studies the underlying business, protects capital, and seeks a reasonable return rather than chasing short-term price movements. Graham's central principles are to treat market fluctuations as opportunities, buy with a margin of safety, diversify, and choose a strategy suited to your time and abilities. Defensive investors should favor simplicity and consistency, while enterprising investors must earn better results through deeper analysis rather than greater recklessness. The book's most important lesson is that successful investing depends more on temperament than prediction. Investors must remain patient, independent, and disciplined when the market becomes either excessively optimistic or excessively fearful.